Hi, my name is Khleif, and I'm the host of the Lifetime Cashflow through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of Lifetime Cashflow through Real Estate Investing. I'm Khleif, and I'm thrilled that you're here. Got a very interesting gentleman we're interviewing today. His name is Jack Krupey, and he's the founder of JKAM Alternative Investments. That's JKAM Alternative Investments, and actually hosts a podcast, which I'm going to be on shortly, which is called the Alternative Investor Mastermind. And boy, he's done a lot of stuff. He's acquired over $3 billion in distressed notes back in the day, which I'm very excited to talk about with him. And I think we're going to have a really wide-ranging conversation about where we are in the marketplace right now and what he does. And so stay with us. Welcome to the show, brother.
Thanks for having me.
Yeah, absolutely. So why don't you do a much better job of introducing yourself than I just did? Kind of give us your, 50,000 foot view of your history in the business and kind of maybe bring us current.
Sure, absolutely. So I actually thought I was going to be in the IT industry. I was in college in the late '90s, and the internet was booming.
Right.
And I graduated during the 2001 .com crisis. I'd read Rich Dad Poor Dad, and so I had some knowledge of real estate. And I ended up going to Las Vegas with a friend for my 21st birthday, and I saw the glitz and the glamour, and what I saw happening in the IT industry didn't seem like I was gonna, have a lot of opportunity that I thought I would. So I bought a book on my flight home. It was one of those no money down, how to make $1 million in real estate books.
Oh, really? That's funny.
I read it cover to cover, got back to Rochester where I went to school, and called my college landlord. And 3 weeks later, I had a house, almost no money down, countrywide, 95% financing.
Oh, good God, countrywide. Yeah. I haven't heard that name in a long time.
I went through, I probably had an Indy Mac, I had a First Frank, I pretty much went through. Within a few years, I bought, about 10 properties. I quit the IT job I had and just went full force into the traditional single family, fix and flip, wholesaling.
And this was in Rochester?
Yeah, this was in Rochester. Okay. And I'm from outside of New York City, but just went up there for school and just stayed there. And this was a market you could buy a 2-family house for $60,000 to $70,000.
Yeah, I remember.
They were cash flow positive.
This is when, 90?
This was 2001 to...
2001, you could get duplexes for 60. Wow.
Yeah. And then there was a lot of people from New York and California coming to Rochester because I would put a 15% cap rate on LoopNet, and or it would be a $60,000 house. They would ask, "Is it for one unit?" We're like, "No, it's actually a duplex." So it was a great place.
So
to get
you
started.
Would flip them to out-of-state investors?
Yeah, we did a combination of, but yeah, a lot of that model was the turnkey model before it got so. Now a lot more people do it, but it was kind of the early days.
So you were managing them after they bought them as well.
Eventually, that was probably one of my mistakes because the other management companies weren't servicing the clients as well. So we ended up starting our own property management company, which became a bit of a money pit. Right. It's property management's a thankless business.
No, I was going to say that. There's a lot of burnout in the direct property management business. Like if you own a Plex or own some houses, I mean, this is an Ask Me How I Know thing. You guys know I give T-shirts away at my boot camps that say hashtag Ask Me How I Know because I've made every freaking mistake there is. And one was a management business because they don't call you when they're happy, tenants or owners, okay? And so it burns out pretty quick. So anyway, please continue. You went from the single family.
Sure. So, we built up a business. We were managing, I had about 50 units myself, and we were managing a few hundred. And, most of the money we were making flipping houses was getting eaten up by the overhead of the management company, the insurance, et cetera. And then, I saw the writing on the wall earlier. It was like probably mid-2006. It started getting harder and harder to get mortgages.
Sorry to interrupt, but I want to circle back to something you just said because you discovered that cash flowing on single family properties is not the easiest thing in the world. In fact, it's much, much harder than multifamily. Would you agree with that statement?
Absolutely. I created myself a job I hated. Basically.
Right. I mean, because you've got higher insurance in many cases, higher taxes. The maintenance is much more challenging. And that's what killed me in 2008 and 9 was the fact that you really don't cash flow as well on single family. And I debate this all the time where I'll go on a podcast and we'll do multifamily versus single family. So I just wanted to hammer that point home.
It's a great point. And you have an extra zero on it, but I took some heat and had some struggles in 2007, 2008 myself.
Right.
And but ultimately, it was probably the best thing that ever happened to me. So eventually, it got harder to get mortgages, and we had investors from New York and California coming into Rochester to buy buy properties from us at the Cashflow. And a lot of them, though, were paying cash using home equity lines or buying cash and refinancing. And all of a sudden, nobody had equity anymore in California.
It was like a freaking light switch went off, man. I mean, I remember in '08, late '08, early '09, I tried to sell my portfolio for literally 30 cents on the dollar, and I couldn't sell it. I mean, literally, I'm not exaggerating, which is all I owed was 30 cents on the dollar, and I still crashed and burned.
Yeah, it was a crazy time, and it was tough for me because, I mean, I was late 20s, and the biggest thing for me was I was worried I had this naive confidence that I could actually make it. It's almost like a different kind of imposter syndrome. It was like, was I naive to think that I was going to, be a multi-millionaire.
So you had a little seminar as well. You lost a little money back then too, huh?
Yeah. Okay. And not as Rochester didn't crash as badly as most of the other markets, but the business just froze. It was like, maybe I could have made a go of it. Exactly. Like I could have maybe sold some single family houses, maybe represented some REOs, but I wanted to do something bigger, which hence getting into real estate. So I ended up selling a majority. Some of them had no equity, and I gave them to a business partner, and moved down to New York City. And I'd always wanted to live in the city. Life went differently, and I just got into real estate up in Rochester. So fortunately, there was a lot of private equity and hedge funds that needed real estate people because they were buying
single family.
They were buying portfolios of loans.
Gotcha.
Non-performing first liens, and especially the first firm I worked at was buying non-performing home equity lines of credit. Wow. So the big portfolio they had bought, so National City failed and PNC Bank bought them.
Right.
And they sold $400 million of non-performing second mortgage home equity lines of credit for 3 cents on the dollar.
Wow.
Yeah, this is December 2008.
3 cents on the dollar.
Yeah.
Holy crap. How can you not make that work? Now, obviously, second mortgages aren't the most desirable position to be in in real estate, but at 3 cents on the dollar, how can you lose?
Yeah, and in hindsight is 2020. Back then, we didn't know, there weren't all the modification programs. We really weren't sure if 75% of them were going to get wiped out.
Right.
It turned out to be probably a trade of a lifetime.
Right.
Because the government agencies and regulations really pushed for modifications, which was a really good thing. And we actually made way more money across the board in my time in distressed loans, actually modifying loans and making better deals with the homeowners than the other banks could.
So you did loan mods yourself. What's really funny is when I lost everything in 2008 and 9, I started a litigation support company. And so I actually formed law firms in 5 states, and I supported them. We brought the people that were in foreclosure in. We did the calendaring, the pleadings preparation to stop the foreclosures, and then we had a whole back office team. I had about 60 employees that would do the loan modification. We helped thousands of families save their homes. I hated the business because nobody's happy when they're losing their freaking house. But yeah, it's very interesting. You were doing the same thing. Wow.
Yeah, and it was great. The people that would actually pick up the phone and talk with us and realize that we were way more flexible than the larger institutions. We created a lot of win-win deals. I remember one where the house, he had a $500,000 first lien. We paid $170,000 for it because
you got the first in that case.
Yeah, that was a first.
Wow.
Yeah, the broker's price opinion showed the house was worth about $300.
Right.
So we paid a little over 50 cents on the dollar for it. And the guy was a military veteran, just kind of bought at the peak of the market.
Sure. A lot of people did that in 06.
Yeah. And then he had a job loss, but he had gotten a new job. He's a government contractor now, made good money, just didn't have 80 grand to reinstate his loan.
Right.
So we made a deal. We actually, let him just start making his monthly payments again, and we agreed to sort of just accrue the
stupid not to, honestly. And just if he sells, you got to pay you off, but other than that, he stays in the house.
Yeah.
That's smart.
And then fast forward 18 months later, there was one of the HARP programs, the Home Affordable Refinance Program.
Okay.
And we told him, if you could refinance us off, we'll likely give you a discount. And his house at that point appraised for $400. He got a new loan for $370.
Wow.
We gave him a $130,000 discount, and we made $200,000 on that mortgage.
On one mortgage.
So those days are over. That was that was a 2000.
Come on, man, you get me excited. Before we started recording, I'm like, do you think there's going to be an opportunity for home loans? I'm sorry, for distressed loans to be purchased, and I'm creating a fund myself right now, kind of an opportunity fund like that. But the focus would really be distressed assets versus distressed loans because it's just not my wheelhouse. But But so let me ask you that question. Do you think there's going to be some opportunity to buy some distressed loans in the commercial world with what's coming?
Absolutely. It's 100% going to be the commercial, not the residential.
Right.
But the residential supports the commercial to some extent as well on I don't think this is going to be a 2008 type of crash. It'll be more like the 90s or the late 80s, the savings and loan, the RTC days.
Right.
And
Which was all commercial at that time because, savings and loan was doing loans on all sorts of commercial property. Let me share some stats with you guys while we're having this conversation because it's timely. So this is this month's Forbes, and it's talking about office occupancy in 6 of the major cities. So this will blow your mind. So right now, New York City is at 80% occupied. Chicago's at 73.9% occupied, office, the whole city. LA's at 73.8%. And San Francisco, 67.3% occupied. Houston, 70.3%. DC's at 78%. But I mean, these assets don't break even if they're not in the 85 range at least, I would guess. What do you think?
Yeah, at least the other problem is those were probably bought at 4 or 5. If these are the Class A was probably bought at like a 4 cap rate. Right. And now at 70% occupied in a market where people are less bullish on office. I don't know whether office should be at a 7 or an 8% cap rate now to take it for the whatever the new risk is of likely occupancy being lower.
And cap rates based on risk, just so you know. So and
then some of them will convert. I had this conversation recently too.
Convert to multi or something?
Yeah, so I lived in the financial district in 2008, 2009, and there were a number of Class B office spaces that were rented for about 35 a square foot as a Class B office, and they would rent for 70 as a high-end residential.
Interesting.
But not all buildings support that. It really depends on, sometimes water's an issue. Offices, you might need 1 or 2 toilets for the whole floor. Right. 2 bathrooms. Residential, you need 1 for every apartment. So sometimes it just doesn't support it. Right. But when it does, that'll work. But in the more suburban markets, a suburban office park is not going to convert. That's probably just needs to be torn down, and it might be good land, but it's not going to be.
But see, the problem with that is somebody's got to take the hit. So here, same edition of Forbes. These are the casualties in the commercial space, the highest casualties so far. So there's 5 of them here. So in L.A., gas company tower, $465 million default. New York, 697 Fifth Avenue, $450 million default. 1740 Broadway, $308 million default. 777 Tower in LA, $289 million, and another $240 million in San Francisco. These are high-end casualties. And, and as we discussed before we started recording, a lot of this debt is held by local and regional banks. So unless the Fed does another bailout, there's $1.6 trillion. I get mixed numbers on that. I read somewhere it was $1.6 trillion coming due by the end of next year, but then somewhere else somebody said that's the total in commercial debt. So I don't know which number is accurate anymore, but it's still staggering.
Yeah, it's a double whammy too. The ones that are performing are at a lower interest rate, so it's the same issue they had with owning treasuries. If they own a 3% mortgage, it's not worth 100 cents on the dollar right now if they have withdrawals. And then the second thing is, the ones that are in default, that's a double whammy.
Right. And we've got of course, forget office in the multifamily space. We've got a ton of guys that did bridge debt over these last couple of years, and they're getting their clocks cleaned right now. And there's a 75% year-over-year decline in multifamily sales first quarter of this year, and and those guys that have non-performing or bridge debt that's already gone up in value, up in interest rates, have 2 options, to refi or to sell. And the sell doesn't look good, and the refi really doesn't look good with, rate caps being what they are right now. They're insane. I saw an article about rate caps where in 2020 you could get $100 million rate cap, 3-year, 3% rate cap. It's not going to go up more than 3% in 3 years. It was $26,000, $23,000 or $26,000. Today, that rate cap for 1 year at 3% is $2.3 million. So, how do these guys, they got to pull money out of somewhere. I guess they can do capital calls. Plus, they've got to meet their debt service coverage requirements at a higher interest rate, which is tougher. So I don't know. I think there's going to be some pain, brother. I don't know if you agree.
It's certainly a bit concerning. And I'm in over 40 deals, and fortunately, we're in a bunch that are Fannie Mae.
Right. Those are great. Right. I got 10-year fixed Freddie Mac on the debt on the 2 that I bought this last year.
Yeah. And then the deals that do have bridge, you're right. Debt service is more than doubled.
Right.
The value add is holding up. So as long as the operators that are executing, there's certainly no cash flow to pay distributions, but at least the way we're modeling the deals we're in, if basically you're just renovating your way out of the problem,
right?
And hopefully the cap rates.
But the rents have declined. I just I got my CRE little update from Connect CRE, and rents have started to decline, I think, on a national level.
Yeah, I've seen that too, and I'll have investors send me articles on things, and it's still so regionally dependent.
Yeah,
I've seen Phoenix decline 5%, but in the class C+, B-, where there's a shortage.
You're right. In San Antonio, our asset there is we're still getting our rent bumps on our turns. So yeah. So anyway, I interrupted your bio. Please continue.
No,
I know you bought $3 billion worth of non-performing debt.
So basically, I left that one firm I was at for a few years where I learned the business, and I just went on my own. I picked up a number of clients. I was buying small batches of loans from a few of the private equity funds that would buy large portfolios, and it would trickle down, and I'd buy 5, 10, 20 loans for a couple $1 million.
Nice.
And
did you have the team in place to make those phone calls? Because trying to deal with all those homeowners can be a challenge. Or did you do it, or how?
We used a third-party servicing company for the day-to-day, but I would get on the phone with the borrowers. I was the second level of support, and I was
for
definitely
a mod or
exactly.
A workout.
I was making sure that. Sometimes if you're not, the servicer is a lot like a property manager. You have to manage them. You have to be behind the scenes pushing them.
Asset management.
Exactly. Otherwise, they've got thousands of loans and then they're just going to kick the can down the road.
Right.
So we were there to make sure that if a deal made sense, we would do a modification. And then if it didn't, the foreclosure would get started and we would push it forward if we had to. And so I did a boutique business with a business partner, just kind of a small family office, just running about $5 million of capital, and then a group of Bear Stearns guys that had left Bear Stearns and wanted to get into the mortgage space. Just met them randomly for a coffee in New York. Didn't know what I was walking into, and we did a $5 million test pool. Went to 10, went to 100. Eventually they partially acquired us.
Your deal.
Yeah.
Good for you, man. That's awesome.
It was right time, right place, and but I was active in the business.
What year was this?
This was 2014. We started that deal.
Okay.
And between 2014 and 2019, we bought $3 billion of loans. We bought directly from Freddie Mac, Fannie Mae. We transacted with Goldman.
Now, was that primary residential?
Yeah, these were large residential pools.
Interesting.
And so we'd buy 1,000 loans at a time and do a lot of modifications. And the demand for reperforming loans was really strong as well. So we made more money making those deals with the homeowners, getting the loans performing. And
then you'd sell them off again?
Yeah, and it's sometimes close to par. When interest rates were really low and we had loans with 4 or 5% interest rates, there was strong demand from Wall Street.
Wow.
And we even did securitizations, which it sounds...
You did.
Yeah. We threw Goldman and Nomura.
Gotcha.
And it sounds kind of more exciting than it was. It was essentially just refinancing of debt. So
you just get it. You're just basically selling. You're getting out of the debt.
It's basically a cash out refinance.
Right. That's the simplistic way to put it.
But it was interesting. I met one of the characters in The Big Short.
No kidding.
The character that the Deutsche Bank character in The Big Short. In the book, they use his real name, Greg Lippman. But he owns a firm called Liebermax, and they were participating in some of the bond offerings. So it was interesting.
Those were crazy times, man. In my foreclosure defense business, we saw so much fraud from the big banks. I mean, it was insane. When you said Deutsche Bank, big time notes, because the problem was, to foreclose on these things, they had to have a decent, they had to have all the documents, and the documents were scattered all over the hell and gone because these loans had been sliced and diced so many times. So they had to basically fabricate documents to get the foreclosure process through, and they absolutely did it. I saw it. Yeah. So, call me out on it if you want, but I saw it firsthand. It was crazy.
Diligence was a big part of the process. Just tracking the assignment chain. Did it actually exist?
All of that.
Going back 3 orders prior to find someone who could sign because there was a break in the assignment chain. Because during the boom,
these banks would assign these debt. That's what you're talking with the assignment chain, right?
Yeah. They would sell
at the
note
level, not the ownership level. Right. Yeah. It was crazy.
Yeah. It was
crazy times, man. Yeah. It was. For a while I enjoyed it, but nobody's happy when they're losing their house. And I sold that company a few years ago. We had 60 employees. It was about a $10 million company, not huge, but we had. The guy, he's killing it now. The guy that bought it from me, because the foreclosures have really ramped again. They had the moratorium, so they've really ramped again. So what'd you do after that?
Yeah, so I started investing passively in syndications while I was there in New York.
What asset classes?
In multifamily. I met a guy locally at a meetup group who lived in Long Island but was buying in Georgia, South Carolina. And similar story that we talked about earlier. He had owned some single family, realized it was a grind, and started going bigger. And so I had some exposure to it passively while I was in New York.
And when was this?
This is, I think my first deal was like 2015, 2016.
Okay, good.
And, I starting in real estate, I was a real estate professional, and I didn't even know it in my 20s. So I was used to having like losses carry forward.
Right.
Yeah, exactly. Unprofessional, professional.
Right.
When I was like 20 something. But
could you explain the difference for my audience?
Sure. So, when you're a real estate professional, there's a designation from the IRS, and loosely it's 750 hours in the real estate business per year, but 500 of them are supposed to be in rental property activities. So, and this is a fine line, so certainly not giving official tax advice.
Right. No, of course. There's no tax advice here, guys. We're having fun. Okay.
Yeah. But you're supposed to be, actively involved in rental property activities for 500 hours of it. And if when that happens, generally all of your income gets pooled together. And if you have losses on paper through depreciation, it basically
go against ordinary income.
Exactly.
Yeah, it's fantastic. I mean, it's why most people that do real estate for a living don't pay taxes. Period. Now, and when you're investing passively, you can like a lot of operators will do cost segregation, and there's still 80% bonus depreciation. So you'll get your income, your passive income, offset by some losses, but you can't go to your active unless you've got that designation, right?
Exactly. So I found myself all of a sudden, I've got a private equity job in New York. I'm taking a big salary with a bonus. I own a piece of the business.
Cool.
And eventually it got to the point where my ownership of the business was paying me more than my salary, and I'm losing 50% of my salary in New York City. And it's just sort of, I got into real estate for passive income and to have freedom and flexibility, and it became a grind where it's like you're guilted for taking vacation days.
New York and California, man. I mean, I don't know how people survive there. Honestly, the taxes are so onerous. In fact, there was just a headline today where landlords in New York are getting hammered for. Did you see that? Literally, they just passed something where there's a much more loose description of fraud. Based on raising rents, and they can go retroactive 5 years against New York landlords. Just passed today. Literally, I should have pulled it and brought it over. But,
it's crazy. And I heard about California just blanketly putting rent control on certain property. It's not like you had to opt into it. It's crazy. So eventually I burnt out in New York. I really just being an entrepreneur first is really tough to just do that kind of private equity grind.
Sure.
And I was like, I can't do this for another 10 or 20 years. I want to travel the world and enjoy my money. So I ended up leaving, and I moved to Puerto Rico, which has some pretty amazing incentives.
Right.
And then eventually I got bought out. I'd already been in a number of syndications passively, and was decided to do it as more of a business. A few of the operators that I was investing with, explained to me that even though they're successful and able to raise money from friends and family, that when you have to raise millions of dollars in 30 to 60 days, it's always a sprint.
Right.
So I knew after being in the property management business when I was younger and having that grind in New York, I didn't really want to be a full-time operator. I'd preferred to try to build a passive business. So I focused more on allocating money to a select group of partners, probably some of your students and
very likely.
Members,
we'll have to find out who they are. I'd love to know, because I'm sure I know 75% of them.
Yeah.
But so you have a fund that invests in other operators' deals. Correct. And you come in as a limited partner, and sometimes you have a co-GP relationship as well. And that's a very common dynamic, guys, by the way. And I've got students that have done that extremely successfully. Raised hundreds of millions and gotten involved in thousands and thousands of doors. But so that's effectively what you do. Well, I know your website is JKAMinvestments.com, and again, his podcast is Alternative Investor Mastermind, just so I don't forget to say that. But let's talk about some more global stuff. Were you finished with your introductory bio that I kept interrupting?
Yeah, that was good. It was a good one. That's why I was. All right, we covered a lot of good stuff in between.
And that's the whole purpose of this, is to educate you guys. And so talk about. You gave me a topic to ask you about, and I'm intrigued as to where you're going with this, and that is how to avoid the last straw moment. So can you elaborate on what you mean by that?
Sure. So, I was kind of giving a little preview, I guess, about, for me, I was in New York. I was losing half my money to taxes. Ultimately, I just wasn't happy. I was making a lot of money, but I wasn't happy. I'd sort of trapped myself into a job I hated. And I think you need to do some soul searching when you're trying to figure out like what part of this business to get into. And I know a lot of people who make 7 figures that just their first thought is I just want to be an operator, and then they think I'm going to go buy an Airbnb or I'm going to buy a single family house. And you need to be really mindful and really thoughtful of your lifestyle design when you're an accredited investor and you're trying to get towards retirement and passive income. I think a lot of people just default to what they think the simplest thing is to buy a single family or do an Airbnb or just try to do everything themselves. And I've used the quote, I've heard it on other shows, that real estate's a team sport. And I think to avoid that burnout and that trap, that never-ending trap of never quite getting passive, and even the business I'm in now, it's not fully passive, but I'm going to Hong Kong in 10 days and I don't have to worry that my phone's going to blow up because a toilet's overflowing at one of the properties. So I think it's really important to look at passive income and really design your life and your investments around
your lifestyle.
That lifestyle.
Yeah, lifestyle. And how much bandwidth do you have? If you're going to be an operator, you're going to have some bandwidth. I mean, I've got my students, I'll brag for a minute, my warriors, my coaching students now own upwards of 170,000 units that we know of. We're doing a count right now, and I've only been teaching 5 years, so I'm really proud of that. And when you say team sport, most of those were done between warriors, so everybody playing to their strengths, and some of them invest passively, some of them both passively and actively, and it works very, very well. And it absolutely is a team sport. There's no question this business is a team sport. And that's the beautiful thing about it, candidly, is, if you do want to be operational, there are several different hats you can wear. Obviously you can be the one that finds the deals and raises the money, similar to what Jack does here, at least on the equity raising side. And then, or you could be the one that does the underwriting. If you're, obviously you're very analytical as well, if you were going to be in the IT space. And so that's required. And then there's the asset management piece. So somebody with some construction experience or some project management experience or something could do that. But if you don't have the bandwidth for any of that, then you're crazy not to explore passively investing. But when you say last straw moment, I didn't pick up on that move from New York. By the way, I got married in Puerto Rico. I freaking love Puerto Rico. We talked about that a little before we started recording. Love the hotels there and the people there and the climate, of course. And of course, the tax is, it's interesting. I've had some economists on the show. Harry Dent, for example, lives down there.
Oh yeah, I've met Harry.
Yeah. And it's pretty extraordinary place to live. I don't know if I could talk my wife into it, but I totally would move down there if I could. But what do you mean by last straw? It's just like you've reached the point where you're looking at life differently, or
maybe it was you might call it a midlife crisis, I guess. Okay. Yeah, I mean, I had some. I was developing TMJ in my jaw from the stress. Like if I would yawn, it would crack like you're snapping your fingers
because you're clenching all the time because you're stressed. Yeah, wow.
I guess you'd say I became an official New Yorker because I saw a therapist. I think it's like a rite of passage in New York City. It's like almost everyone I know goes to
therapy.
It was helpful, but for me it was deciding that to some extent the money wasn't even as important as the freedom for me. And as someone who started as an entrepreneur, I kind of gave myself golden handcuffs, and so I could see it from the perspective of somebody who's also trying to retire or trying to become self-employed and build passive income, but is afraid to take that step to take the step into doing real estate and investing full time. So for everyone it's different. For me it was just started to affect my health, and really just had to.
You have a family, or is it just you?
A wife, no children. So it made it a little easier.
Right.
And
she's happy down there too.
It's still
still new.
It's 90% great. I think like most areas.
You speak Spanish?
Poquito.
Okay.
Yeah.
Okay.
It's like Miami. I mean, everybody speaks English too. I understand more than than I speak.
Right.
I should make more of an effort, honestly. It's because I'm an outgoing person too. Once I get to a base level, I'll just be asking everyone, "Como se dice this, that?" It's enjoyable. And there's also I wouldn't say expat because everyone's still a U.S. citizen, but there's a great community of entrepreneurs down in Puerto Rico. There's about 10,000 people who've moved down there for the various incentives, and
some big players. I went to is it Exit Realty? Which Realty is the
EXP? A lot of people went down there.
EXP, yeah, some big hitters in EXP that make $1 million a freaking week or whatever move down there because they're just getting killed in taxes.
And I could cover the very basics of there's two major tax incentives that people tend to use down there. One of them is the Export Services Act. And so
elaborate on this.
Sure.
Please.
So if you're a resident of Puerto Rico, you don't pay federal income tax. Now, if you're just a random lawyer in Puerto Rico, the typical rate's 33%. So there's not generally, you can't just move there and get any break.
How do you get residency though?
You need to live there 183 days of the year. And you also need to pass the closer connection test. So you can't just hop on a plane 4 days a week and have your wife, your kid, your dog, in another area and just say you're in Puerto Rico. So you got to really be there. You don't need to be there all the year, but you have to have a presence there. And any money you make off island through what used to be called Act 20, now they've consolidated this under what's called Act 60. But any money you make off island, so that could be a consulting business, a education business, fund administration, fund management, is only taxed at 4%.
Wow.
And there's also...
Do you have write-offs that go against that as well, or you're going to pay
certain things?
4%?
I mean, honestly, I'm probably not as diligent tracking every receipt at 4% than I would be for picking up a dinner here and there. Sometimes I just throw the credit card out and maybe don't expense every dollar I would have. But there's the standard business deductions you can use as well.
Okay.
And then the other powerful thing for there's a lot of stock traders and cryptocurrency entrepreneurs because there's no short-term or long-term capital gains.
Wow.
That short-term for stock traders is super powerful.
Right.
I mean, I know some guys who have 6-figure days that would be taxed at 50% for trading, and it's zero.
That's crazy. Yeah. Wow, very cool. Yeah, I like I say, we love it down there, but it's a big move. It's definitely a big move. So, what would you suggest to people to prepare themselves for this economic, storm that I feel like we're in, and we haven't gotten anywhere near the end of yet?
Yeah, so I mean, I have some mixed feelings. I've got some scars from 2008, like you've mentioned.
Yeah, we're both carrying around a bag of memories that probably make us a little more bearish than most.
Oh yeah. Like every couple of weeks, I'll listen to Peter Schiff, and I'm like, gonna go buy some gold or fly to Singapore.
You want to shoot you? Yeah, Peter and Harry both are like, oh, good God! But they're bound to be right eventually, and I think now they're going to be right. And I bought a lot of gold and silver recently too. But anyway.
Yeah. So at the same time, I mean, you can't just sit on the sidelines and cash either. So, I think there are still some good deals out there. You just got to be selective, and you got to be in the know and in the right network as well. And that's the power of just getting out there and being part of these investment communities. I think it's just as risky to have money sitting in the S&P. Over 10, 20 years, you may average 8%, but what was there, 23% drawdown last year? So, the whole Vanguard index fund that the traditional financial advisors preach, I'm not a proponent of that either. So I think you need to be selective and get into good opportunities. I think there's still good opportunities today. If you find a deal in multifamily today that cash flows with a close to a 6% interest rate, if you've got fixed rate debt and a 6% interest rate and positive cash flow, there's no reason not to allocate into some deals now. And I am a
as long as it's not short-term debt.
Oh, exactly. Like if you have fixed rate, and what calms me is looking at the dollar cost averaging examples of if you put money into the stock market the day before the 1929 crash. And you put it in the day before, it would take you 12 years to break even. However, if you invested 6 months before and 6 months after in equal amounts, within 2.5 years, you'd break even.
Really?
And I think the same could be said for real estate. If you bought everything in 05 to 07, you're in a world of hurt. But those that if you bought 1 or 2 properties at the peak, but then started buying all the foreclosures and kept going. So I'm a proponent of just continuing to build network, look for deal flow, and that's where the great deals will happen too.
Right,
I've got 2 deals last week.
Right, but me too. We got LOIs on 3 deals going right now. And here's the thing. I mean, I was very interesting example you gave about the Great Depression, but honestly, our business is empirical. It's primarily numbers. If the rents are there and you're not being aggressive, like I saw some pro formas back in the day. I won't mention big names. It was a big name everybody would recognize. He was pro forming 10% rent increase for the next 5 years. I mean, come on, and right now what we're pro forming is 0 rent increase for the next year, and then 3% after that. I mean, very, very modest, on our projections. And I think if you're conservative like that, and the numbers make sense today, why not? I mean, it doesn't matter when you buy as long as the numbers make sense.
Agreed. And I catch myself saying this a lot. It's, I think, a good point to repeat again to your audience is I focus really heavily on the value add. Interest rates you don't have control over. But if when you're doing diligence on a deal, if they're projecting a $300 rent increase on a renovated unit versus a classic unit, and you believe that number, and that number's maybe it's attainable because the prior owners have done a few.
The market shows it. Comparable properties are getting it. For a truly comparable asset. We're looking at an asset right now in Tampa, and we're just making sure that our projections are real. I think they are. But the other piece is it's not. When you say value add, sometimes value add is just bring the rents to market as well. It may not really require a ton of CapEx. It could just be bringing the rents to where the market is, and that's a much safer bet than projecting increases in the future, right? Would you agree?
Oh, absolutely. Yeah. That's the one key. If you nail the value add, you're going to keep yourself out of a lot of trouble.
Right.
If interest rates go up a half a point further somehow.
Right.
But
they're saying they're going to. Yeah. I mean, I just saw it today. Literally today, he said, don't assume that the rates aren't going to go up more before the end of the year. Literally just read it in Fox or somewhere today.
Yeah. And then there are I'm starting to see, I got sent 2 deals that have distress in the last 2 weeks where they're looking to raise additional capital instead of capital call. One was the traditional bridge loan and the construction went over budget. The other one that was interesting though is they had 10-year debt with 3 years interest only.
Okay.
And it was a Fannie Mae deal, so they don't have the rehab budget built in like a bridge loan would. And they're a little behind in their renovations, and because they have not pushed rents enough, the interest only is expiring and they're going to have some cash flow issues. So there's an opportunity to get into a deal as a bit of a bailout that's got 7 years of debt at 3.6%.
So it's an assumption. Wow.
Yeah. Or just a recapitalization where you can buy yourself into this deal.
Yeah. But obviously you'd have to make sure that you're able to meet their pro forma numbers on increased rents. And so let's dig into that deal just a little bit more. So they're going to have trouble cash flowing because they didn't get their renovated units done quickly enough?
Correct.
Okay. So on the ones that are renovated, they're able to get the rents that they needed to have the deal make sense?
Correct.
Okay. So you just come in, you recapitalize, and then you finish the CapEx and get the rents where they need to be.
Exactly. And it's just a negotiation of, how much the other investors are to get diluted.
What
Is
state?
it preferred equity? It's in Texas.
Texas.
Yeah.
The other thing that's killing people in Texas right now, ask me how I know. We've got multiple assets in Dallas, and we've got assets in Houston and San Antonio, and insurance is freaking killing us. So I'm sure you're factoring that in.
Oh yeah,
when you're
that
evaluating.
actually just killed a deal. We had a potential HUD assumption with a 2.5% interest rate.
Oh my God!
And ended up the deposit was returned. It was the contracts were set right, but we thought it was like 30 days from closing, but HUD at the last minute demanded the higher insurance premium than the previous owners had. And so it was going to...
You mean in their pro forma, in their modeling? Or?
Yeah, well, even what the current owners were paying, I guess HUD was requiring a different level of insurance, and it was going to raise the price significantly to the point where it changed our numbers.
So more comprehensive insurance?
Yeah.
Oh, interesting. Wow. Yeah, that's HUD deals are very regulatory. They take a long time to close, but my God, 2.5% interest probably still had over 30 years left on it. I mean, that's 35-year mortgage.
Deal.
Yeah.
And this was earlier this year,
Those loans are fantastic.
Yeah, because a lot of my investors and partners are afraid of bridge loans and everything. So to have 2.5% long term was a really, we were excited about that deal.
I'd be afraid of bridge debt too, brother. I mean, there are so many operators right now that are sucking wind. My partner, I'm in a few bridge loans. We're okay. Things looking good, but there are a lot of people that are sucking wind, and so our debt service coverage ratio has been hurt, and I keep telling him he should stop his distributions right now, and I think he's going to here shortly, but better be safe than sorry. I mean, you saw that big Houston foreclosure, I'm sure, the 3,300 doors there, that nefarious guy.
Yeah, that
made the whole industry look bad. It was in the Wall Street Journal, everything else. One of my competitors' students, and it's a shame.
There's hit pieces in the mortgage industry too. We kept getting hit with hit pieces that we were vulture Wall Street firms buying non-performing loans, even though a vast majority of us were good operators helping the community.
Sure we were.
But the reporters don't care because it's not.
It doesn't sell papers. They want to make people look bad. Yeah, and yeah, it's a shame that comes out. And please, if you're thinking of investing passively and you're concerned about that was a pretty nefarious character. I've heard some really negative stuff about what happened there. Ran off with money, went to India, whatever, and really didn't know what he was doing. That was obvious. And it's amazing he was able to buy as many units as he did. But
yeah, and it's rare. I mean, the barrier to entry is pretty high. I mean, there's net worth requirements, there's liquidity requirements, there's experience requirements. It's I'd say to have someone run off with money is extremely rare in this business.
That's very unusual. Very unusual. I've got a little back door into some of the stuff that happened there. I know some of the players involved, and not a good situation, and it's a black eye for the industry, and it's unfortunate because some people will see that and like, oh man, I'm not going to invest in multifamily, which is stupid because there's incredible opportunity coming, in my opinion, and there's so many pluses to doing it. Hedge against inflation. And typically, if you've got an operator who knows what they're doing, they're not super aggressive. A lot of these guys use bridge debt just to get their return numbers up, so they didn't have to raise as much money. With Fannie and Freddie, they're not stupid. They dropped their loan to values down to 70% and then 60% now because they see the writing on the wall. But you were able to get 80% bridge debt. And they weren't using it for quote unquote bridge, to bridge from one, from unstabilized to a stabilized. They were using it to get the returns they needed, because obviously the less money you put into a deal, the higher returns you can typically project. So
yeah, absolutely. And they're still now. I mean, bridge debt without a cap would be 8% most of the time, but they're in some cases they're just prepaying the interest, calling it a cap, but it's really just paying points to buy down the rate.
Yeah, I heard a guy at the IMN mid-market conference I went to a couple weeks ago for the Southeast region here, and they have fixed rate bridge now, and I'm like, oh yeah, he's like, yeah, man, this is awesome. I said, what's the interest rate? 9. Now listen, just so you know, I mean, when I got in the business, this is 1978, interest rates were 18%. And I remember doing backflips when they hit 7. So, we could see some higher rates. That article I read about Powell saying the rate increases are going to continue also said that they're closely watching what's happening in the commercial real estate space. Thank God, because I don't think they do much else, but don't get me started. But anyway, I hope that I hope they don't go too much further because I think we're really going to see a train wreck, and I don't think there's anything to prevent what's going to happen in the office environment. I just hope it doesn't.
Yeah, that's
done. It's done.
Yeah, it's a generational shift that.
It's like Bud Light at this point. It's done. Yeah. Sorry, I went there. Couldn't help it. But
I've got a meme to show you after the show.
Okay, good. Okay, but So why did you come up with the name Alternative Investments? Elaborate on your definition of that. Is that just talking about what we're talking about, which is multifamily passive investing, or does it go beyond that?
Yeah, it's definitely more than multifamily.
Okay.
I just have, and I knew a lot of these people in New York that the accredited investor that's worth $1 to maybe $20 million.
Right.
I think a high percentage have 90% of their money just in the stocks, bonds, the traditional financial system. When you look at a family office or those that are worth $50, $100, $200 million, right, more than half of their money is typically tied up in private equity, real estate businesses. So and the laws have changed with the credit, the 506C. Mm-hmm. It's really just the last 10 years or so.
Right.
That
you can advertise. You can. I mean, good Lord, I remember back in the day, you had to have the 3-touch rule where you had to have talked to them 3 times before you could offer them a deal. And now I can shout it from the freaking rooftops.
Exactly. It was really tough. It used to be like a country club industry. You pretty much would hear about them from a guy at a country club.
Right.
And now with the internet, it's really opened up access to to the masses.
Right.
There's 3 million accredited investors in this country. So okay. I've always been an evangelist. I was the guy in my early 20s telling my friends to buy a 2-family house hack, rent the other half. Mm-hmm. And then when I got into non-performing loans, a lot of real estate investors went from flipping houses to buying loans and flipping paper. Mm-hmm. And I was always kind of shouting from the rooftops trying to help people just get into good deals.
Right.
And now I'm at that stage in life, a lot of my, friends, colleagues have amassed some wealth and are looking to kind of plan for retirement. And I just think that there's superior opportunities out there outside of that traditional.
Give some examples.
Yeah. So, I mean, multifamily is one of the core asset classes.
Sure.
I've got probably half of my funds
right.
there. But, self-storage.
I love it.
Mobile home parks, student housing. We did 2 student housing deals in late or early 2021 when everyone was a little bit afraid of COVID still,
Right.
but 2 deals in SEC states where kids are still going to school. COVID wasn't as big of a an
Right.
issue
Right.
as other parts.
Right.
SEC
states.
like the SEC football, the
Gotcha,
Southeast.
gotcha.
Yeah.
Yeah. Okay, got it.
So what else? I mean, I'm in some oil and gas deals. I don't need it just because of the tax status I have, but yeah, I have some doctors and some others that
Some
have
good
high
things
W2.
about oil and gas deals.
Yeah.
One of my past students is big in them now. Some of the other asset classes you said, I have a student that's huge in the self-storage space now as well, thousands and thousands and he said it's softening for sure, okay? But everybody has their stuff, then most of the time they don't want to give up. So I don't think it's going anywhere. Mobile home parks I freaking love, absolutely love those. What else did you say?
Student housing.
Student housing. Now, don't let Harry Dent scare you off of student housing because he's convinced that that's going to fall through a floor because of the he focuses his rhetoric on population demographics, right? And how there's going to be a drop in enrollment just because of a drop in that age group. So I don't know.
Yeah, no, that's interesting. I haven't heard that specific quote from him, but I do. I mean, that population stuff I follow. I follow another guy named Peter Zeihan. He's done tons of geopolitical stuff and talks about. He's one of the few economists that's bearish on China because of their one-child policy and their population. There's a lot of old people and not enough
Just
young
like
people
Japan.
there.
Japan basically has been stagnant for 20 years because of their lack of population.
Yeah, so if you listen to too much Harry or Peter and you're feeling,
I would ask Harry though, because I will tell you something. I don't admit this very often. I did when I interviewed him. Is if I went and saw him. I don't know, maybe in 2000, the late 90s, I went to Vancouver, saw him speak, and he said, man, make sure you are out of real estate by 2007, 8, 9, something like that. Had I listened, I wouldn't have lost $50 million. Now, nobody listened basically back then. But he talked, the one thing that stuck with me was the conversation he talked about with students in colleges and student housing. So since he's in Puerto Rico, I'd hit him up and ask him what his thoughts on that are. It'd be good.
They're certainly do a deeper dive. Yeah. So the Peter Zeihan thing. So like if you listen to too much Peter Schiff and you start worrying about the U.S. and the U.S. dollar, Zeihan is still pretty bullish on the U.S.
because there's the BRIC thing going on right now. Egypt just joined, and so you've got all these nations. But I also saw something as well where they're not as worried because the U.S. currency is still so powerful and so strong. I mean, I get sucked into that conspiracy stuff, and it's really not conspiracy. I mean, that's happening. And what scared me about the BRIC thing is it's backed by gold and silver and commodities, which the dollar's air basically. But China has manipulated their currency so much as well. That was another component I heard. But anyway, tell me what you've heard from this Zeihan guy.
Sure. So, just the fact that the U.S. is also our energy sector. I mean, we're a net exporter. We're energy and food independent. There's only a few countries in the world that are energy and food independent. China is not one of them. So they are importing heavily for both. The only other countries that are energy food independent are Argentina, and their political system has been
it's a joke.
It got destroyed. Perpetually for like 30 years. There's like a black market for U.S. dollars there. So if you change at the airport, you'll get 250 pesos to $1, but you go to a Western Union, you get 500 pesos to $1. So everything is half price if you bring U.S. dollars there.
Interesting.
So
this is Argentina.
Yeah, this is Argentina. So overall, he's just very bullish on the U.S. that we're in a pretty good place.
Let's hope he's right, man. It is a little sobering, when you see everything that's going on. They're still printing money. Inflation's insane. They're talking about that. What is it? Fed Now program for digital currency. It's a little sobering.
Yeah, I mean, and look, over the next 20 years, something's probably got to break.
Yeah.
I mean, there's a crisis every 10 or 15 years.
Right.
I don't think either party has the wherewithal to actually run a surplus. No. It's going to take a crisis, or the rest of the world
really
pushing
a reset.
Us not to.
It's going to take a reset, I think. And listen, we're not trying to scare the hell out of you. Actually, trying to get you excited because with crisis always comes opportunity, and I think everything's going on sale. In my opinion, I think there's incredible opportunity to buy businesses. There's 80 million baby boomers. A lot of them own businesses that they're going to want to sell, and they're going to have a hard time selling. Of course, any real estate asset class except office, would be something I'd consider. I'm not even sure about retail. A little questionable about retail as well. What are your thoughts on retail? Just curious.
Yeah, I mean, So the former CEO of Best Buy spoke at Kellogg. I did an executive MBA program a few years ago while I was waiting out my non-compete. And, he's still, retail's not going fully away.
Right.
Well,
no, for
online,
sure.
He just looked at it as multi-channel marketing. For every person that just buys something on Amazon or goes to Best Buy, plays with it, and buys it on Amazon,
right.
There's someone else who's shopping on Amazon for a week and says, you know what, I want it now. I want to go into the store, or I want to touch it and play with it, and I'm going to get it immediately. So, I mean, retail's going to change. You're seeing kind of co-location. Like you go into a Macy's now, it's like they're selling real estate space to a bunch of brands. And that's really what Best Buy's model became, is actually selling space inside their store.
Right, to have little areas that are brand specific. I've seen that in some of the department stores. Now, of course, in the high-end stores, you see it with the high-end stuff. But
yeah, so it's not going away completely, but it's got to change. You know, those random suburban strip malls that are on the side of the highway are probably not the highest and best use anymore. I mean, you want like a mixed use where you've got apartments with a grocery store and maybe a couple select retail stores and some Amazon lockers too. So it's you get the best of both worlds. So
no, I agree with you. That's very interesting. You know, I don't know how the what do they call it, where they have a bunch of stores, factory outlet stores. I don't know how those are doing. It'd be interesting to know that. But
yeah, at the right price, I even think of covered land plays. You know, if you have a long-term playbook and you could buy something if it's retail at a 10 cap or 12 cap or something because it's distressed, but
just for the
in
land,
5 or 10 years you might be able to reposition it.
Right.
You know, maybe it's worth something as well. You just got to be, you know.
Yeah, if you're in the path of progress, you know, if for sure, I could absolutely see that.
Before I forget, you mentioned the buying of businesses. That's actually another alternative investment I've done. So,
oh, no kidding.
Through Kellogg, actually, there was a conference called Entrepreneurship Through Acquisition, and it's somewhat like venture capital, but it's not venture because it's not nearly as risky. Where private equity funds are backing MBAs from, say, Harvard, Stanford, Kellogg to buy existing cash flowing businesses. So they'll actually put a bunch of MBAs on a payroll for 2 years to go out and network with businesses that are for sale. And it's a lot of baby boomers who have family businesses and their kids don't want it.
Right.
And a lot of these businesses, it's almost its own value add because, you know, all these guys are comfortable. They're playing golf 3 days a week.
They haven't embraced tech. They haven't embraced online marketing to the fullest extent, social media, all that. And you get a young blood in there that can take that and run with it.
Exactly.
Yeah,
so I'm actually invested passively in a fund that backs these businesses. So they own a portfolio of like 15 different cash flowing businesses. They're buying them between 4 and 6 times earnings.
Wow, that's not bad.
So you know, it's reasonable multiples. Right. And these are not venture deals where 9 out of 10 fail and you make all your money on one. These are businesses that
they're already existing.
All 10 should stay. Maybe every once in a while you'll have the owner who just, you know, so much of the business was his personality and you know, maybe that. But I think most of these, they're doing a very good amount of diligence and they generally grow. So one of the cool examples was someone bought the 3rd largest commercial roofing company in Ohio.
Wow.
And commercial roofs have a lot more subscription work. It's not just new construction. It's a lot of flat roofs, so it's a lot of service contracts, a lot of recurring revenue.
Sure.
One of their key landlords also owned in Florida. Prior owner didn't want to like go to Florida and like create this new business unit, but this company used one of their key clients and opened a division in Florida, and they've tripled their earnings. In
Hurricane Ian, you're welcome. Yeah, that's a no-brainer. I'm very familiar with that business. My brother owns a fairly large roofing business in Denver. My son actually works for him. They're killing it. They had huge hailstorms there. My son had sold $500,000 so far. He thinks he's going to hit 600,000 or 700,000 this month in sales. So he's like doesn't know what to do with himself.
You better get him some depreciation.
Well, yeah, no kidding. And here's the problem. You know, I thought he was going to come work with me. And he's got, I think he's going to have golden handcuffs at this point because I wanted him, you know, to help me with multifamily, and he's been participating in our meetings. But yeah, that's interesting on what you said about businesses. And I absolutely think there's some opportunity. That fascinating program that you were mentioning. I love that program. Are you an MBA from one of those schools?
Yeah. So while I was on my non-compete, I did a Kellogg executive program, and I did their global program as well. Okay. So I was back and forth. I flew to Hong Kong a number of times. I did one class in Tel Aviv,
Israel.
So
were you working with Kellogg?
Oh no, I did it was their executive MBA program.
Oh,
so
gotcha. Okay, yeah. I've always wanted to do one of those, which really, you do case studies, and Harvard even has an executive MBA program.
Yeah. It was great. You know, I was for about 10. You know, I was in really heads down in real estate for most of my adult life.
Right.
So it was a great time to just get a larger global perspective and being able to spend some time in Hong Kong.
That's cool.
And this was Hong Kong 2019, so the protests were going on.
Oh,
and
wow.
it was just interesting to have a
How long did you finish the program?
Yeah, it was an 18-month program,
That's what I wanted to ask you.
we finished in June of 2020.
Wow.
So we got most of our classes were live. We had to finish the last few online.
Virtual, yeah.
But I'm actually going back in July for our graduation. We never had graduation because of COVID.
Kidding, right? Because of COVID.
So,
Wow.
3 years later, gonna reconnect
cool.
with a bunch of the classmates.
So just out of curiosity, just for my own personal edification, how much time did you have to spend on a weekly, monthly basis for that program? Because that's always intrigued me as well.
Yeah, it was definitely, we would meet for class like once every 4 to 6 weeks. So there was some homework and some prep where, maybe you're spending 5 to 10 hours prep before class. And then it was basically Friday, Saturday, Sunday, back-to-back weekends. Okay. So I'd go over for about 10 days and you'd take 2 classes in that 10-day period.
Okay.
And then you'd have maybe a little time and there'd be like a take-home final or something. So it wasn't insane. I mean,
so it wasn't consuming. You could actually have a full-time gig and still do it.
Exactly. And Kellogg actually has a satellite campus in Coral Gables as well.
No kidding.
It meets once a month. And there's people that fly in from Peru and Colombia and addition to, there's 2 neurosurgeons. So it's an interesting mix of people, and certainly you're far enough in life that you don't need it, but it's actually like pretty rewarding.
No, I would do it to enjoy it.
Yeah,
I've been really thinking about it for myself. I've been threatening it for a couple decades now. So it's interesting that it's circling back. So through this process, of your evolution, did you have any mentors?
Oh, absolutely. I've had a number of them over the years. I've been starting with my first college landlord who, got me into my first number of properties. And then, over time, a few others in various stages. And one of them actually, Brian Duggan, who was in the mortgage business, but had previously been working for a developer in Chicago and got into multifamily.
I know that name. The name triggered me.
Yeah. He's definitely in some deals. He doesn't really, go to the conferences as much, but yeah, he's definitely, been around the block. So, he was one of the first people who, because he was in the mortgage business too, and sort of pivoted into, back into multi. And when I was trying to figure out my progression, and this was, 2017, 2018, 2019, as I was trying to figure things out,
right.
Really, got me thinking heavily about, just getting into the, multifamily and syndication space.
Gotcha.
And there's many more. I mean, I've just been fortunate, and I think I'm I'm an outgoing person, and I also, no ego, and just happy to always learn and have. No,
obviously, if you put yourself through that executive MBA, I feel the same way. Learners are earners. I mean, we stop learning, we'd start dying. That's it. I think you've addressed a couple of these, but just out of curiosity, just curious if anything else comes to mind as through this journey. Did you have any epiphanies as you through this growth process where you're like, holy crap, I get that. Now I get it. Does anything come to mind when I ask that question?
Yeah, I mean, so not being afraid to invest in marketing when I was just getting started. There's about a year where it was like, we should send postcards out. And just, it's like, it cost us less than $1,000. And, this is 2003, 2004. So,
right.
We bought 1,000 stamps, like a roll of stamps.
Oh, yeah.
We did
them all yourself, stuffing
yellow,
them.
Yeah.
Your tongue
one
goes
mailing
numb,
for
right.
less than $1,000, we probably made 6 figures on.
Wow.
And so early on, it's like, okay, and then fast forward 20 years later, the marketing's different these days. It's now, social media, podcast,
right.
Getting out there. And,
right.
Again, I had a bit of a resistance. Maybe it was in New York, it was a little more secretive. I mean, I couldn't speak to the media or go on a panel without getting permission from the general counsel because, we would be in a fundraising cycle and
right.
we had to be careful what we'd say to the media. So,
Did you have your series licenses as well?
No, this was all just private equity.
Gotcha.
But the parent company was, always in a capital raise, more institutional money, but they were just hesitant, or they just thought I was a loose cannon and was afraid what I'd say. Well. Maybe it's a little both. But fast forward 20 years and just, embracing the social media and posting and putting things out there. If I'm one-on-one, I don't shut up about, Puerto Rico and multifamily and investing right. outside the system, but I was hesitant to put it out there for a while. And now that I'm starting to do that, and, I flew here for this, just,
right.
It was a awesome opportunity to meet you and have a
Likewise.
chat.
Yeah.
And,
I mean, I appreciate it. Let me say that rather.
But to actually put myself out there, it's been super rewarding. And I've gotten, emails and thank yous from people who've, learned about something that I've mentioned. And, I enjoy being that evangelist and getting the the word out there.
So that's the way it works. Whatever you give back 1,000-fold. So I mean, you're not only you're enjoying it, you're gonna reap the benefits of it. So
yeah, and for a listener, that means getting out of your comfort zone and going to a live event and or joining an organization.
Yeah.
I've
got a huge event, well, huge by my standards, coming up September 15th through the 17th. It's a boot camp. It's the only live one I do a year because they kill me. It's me on stage for 3 days. But you guys, if you can come to that, I would highly recommend it. There'll be about 1,000 to 1,200 people there, and it'll be a blast. But on that note, do you have any, and we'll just wrap it up here pretty quick. We're going a good bit. I've really enjoyed this, by the way. Do you have any words of wisdom for an aspiring real estate investor now on the on the operating side, not necessarily just the passive side? Any words of wisdom for an aspiring multifamily investor? Because I have a lot of people that are sitting there thinking, man, I should do this, but they've just never done anything with it.
Sure. So, you definitely need to be self-aware enough to know what type of personality you have and what you're going to be able to give. Are you the salesperson that's going to be the capital raiser?
Right.
Are you the Excel guru who's going to be modeling and underwriting? Do you have the property management construction experience?
Right.
And you've just gotta. It is a team sport, and you've got to get out there, and you've got to take some action one way or another.
Right.
Whether it's usually it's events. It could be virtual, but nothing substitutes meeting people.
It's networking, right? Wouldn't you say that's 100%. One of the biggest pieces of this business?
Yeah, 100%. And if you have that fear or limiting beliefs, nothing solves that more than meeting someone else who was in your position a few years ago that has actually gotten to that next step. You surround yourself with
Great
people
advice.
that are where you want to be, and then things happen organically. You don't have to be an extrovert either. Networking, every extrovert like me, and I assume we need analysts. I'm analytical, but at the same time, I'm not going to spend 20 hours on an Excel spreadsheet. I'm not organized enough mentally my Excel sheets would make an actual investment banker sick to their stomach. I can get to a number, but it's it doesn't look pretty. So you just got to take action, and things happen because of that. That $3 billion of mortgages happened because I was selling 10 loans on LinkedIn. And the CIO of the company just saw that I was out there and I was active, and everything builds upon itself.
Cool. Very cool. Now, do you have a team, or is it just you now? Or?
Yeah, no, there's 6 of us, and my marketing guys are part time.
Gotcha.
But
same here.
But yeah, I have a business partner who's his wife's a doctor, and actually, when he just got out of college, he was a financial advisor. So when we crap on financial advisors, he lived it and has that same mentality of mine that more people's money should be outside of the traditional stocks and bonds.
Sure.
And then, investor relations. My wife is a CFO, does the books and compliance and all that. All that good stuff. And it's a great close knit team. And
they all in Puerto Rico, or is most of them up here?
Everybody's scattered.
Okay.
Yeah, actually,
it's a beautiful thing about this virtual world we live in. I mean, I remember I hired some guy. And met him virtually, and we communicated for a long time as he was in the company. And then we're at one of my boot camps, and he's like, "Hey, what's going on?" And we're walking about 50 feet down the hallway before I'm like, "Hey, we've never actually even met," because this is you just assume. The relationship gets pretty tight. So let's end it with this question that I love to ask super successful people like yourself. If you go back and told 18-year-old self something, knowing what you know now, is there anything you'd do differently, or would you do it the same?
I'd certainly say sell all real estate in 2006 and buy it back in 2009. I wouldn't actually change anything though, because those lessons, that pain from 2008 is that's never going away. And and look, I'm in a couple deals with bridge loans now too, so it doesn't mean I'm still not taking some risk and investing. It's for as bad as bridge loans can be, at the same time, there's no prepayment penalties, and sometimes it beats the business model. But I think you need to have that pain of losing money, because it informs. What
doesn't kill you makes you stronger, right? That's how I look at it. I mean, it wasn't fun, and I'm sure it wasn't fun for you either. You lost millions as well, right?
Yeah.
Yeah, and I tell people, life's about meaning, and you can decide what meaning you place on what happens to you as well. And your meaning right there was it made you stronger and Mine as well, for sure. Another meaning I place on is I never would have met my wife, and I'd give it all up again for her. So, if you've had something negative happen to you, you have the choice to choose the meaning you place on it. It can be a disempowering meaning or an empowering meaning. I choose to put empowering meanings on, the things that are perceived as negative that have happened in my life, and I hope you do the same. Well, listen, brother, I appreciate you coming down here. This has been a lot of fun, and I definitely want to stay in touch with you. I've really enjoyed this conversation.
Absolutely, I did as well. And I'm actually going to bring a client or two to your event as well.
Oh, I'd love that.
I've got a longtime friend who made a lot of money in the mortgage business, is looking to pivot, and
love it.
What better way than to bring them to a live event and get them from 0 to 1 much faster than looking at PowerPoint offering memos.
I'll fire them up. That's what I do. We spend a lot of time on mindset and psychology. That's what I'm known for. I spent 20 years with Tony Robbins and best in the world at it. But really, 80 to 90% of a person's success, I'm sure you agree with me on this, 80 to 90% of a person's success in anything is their mindset and psychology. Only 10 to 20% is the mechanics. You have to actually go do it, push through the fear, push through the limiting beliefs, get uncomfortable to go make stuff happen. And so I spend a lot of time on that. It's a lot of fun.
Absolutely. It's great stuff.
Pleasure to meet you, brother.
You as well. Thanks again.
Okay, yeah. Good? That was kick-ass. So one other quick thing. We encounter so many people that are frankly frustrated. They're looking in the mirror and they're frustrated that they haven't been able to escape the rat race. They haven't been able to build cash flow to the point where they're able to have financial and time freedom with their families. And maybe they see other people buying real estate and creating, incredible cash flow, and they think, well, it's just scary. Buying apartments is intimidating. And I get it. See, that's why we created our Warrior Mentorship Program. They're our coaching students, and they've had extraordinary results. My students, I've been teaching about 5 years, and they own upwards of 140,000 units now that we know of, right? And we feel like it's just getting going. Now, we're looking to grow this group and really take it to the next level. And honestly believe that the greatest transfer of wealth could be upon us right now with this current economic environment. Everything's going on sale. So we're looking for people who want to follow a proven framework, really like a blueprint or a map, literally step by step. And then they're able to leverage our systems and our incredible network to raise money and equity, to find deals and close those deals and build partnerships, really nationwide. So if you're interested in finding out more about how you can become more in our incredible network and take advantage of the unbelievable opportunities that are upon us, you can apply to my Warrior Mentorship Program by texting the word CRUSH to 72345, or you can go to mentorwithrod.com. And what we'll do is we'll set up a call so you can check us out and we can check you out and see if it's a fit. Now, again, you can go to mentorwithrod.com or text the word CRUSH to 72345 to apply, and we will speak soon.